If you've been researching retirement strategies, you've probably come across something called an IUL. That stands for Indexed Universal Life Insurance. And depending on who you listen to, it may be either presented as one of the greatest financial tools ever created or something you should avoid completely. The truth is usually somewhere in the middle. An IUL can be useful in the right situation, but it can also be misunderstood, oversold, or used for the wrong reasons. That's why retirees and pre-retirees need to understand exactly how it works before making any decision. Because an IUL is not an investment product, it's a life insurance contract. And that distinction affects the costs, the benefits, flexibility, and expectations associated with the policy. So in this video, I'm going to walk you through what an IUL is, how it works, where it may fit, where it may not fit, and the questions you should ask before buying one or keeping one you already own. And if you'd like help reviewing an existing IUL policy, a proposal you received, or your overall retirement strategy, there's a link in the description where you can schedule a free call. We'll look at your goals, your current plan, and help you understand what options may be available. Okay, let's start with, what is an IUL? An Indexed Universal Life Policy, often called an IUL, is a type of permanent life insurance. Unlike term life insurance, which covers you for a specific period of time, permanent life insurance is designed to remain in force for your lifetime as long as the policy requirements are met. An IUL generally has two main parts. There's the death benefit, which can be paid to your beneficiaries, and there's a cash value component, which may grow over time. What makes an IUL different is how that cash value growth is credited. Instead of earning one fixed rate every year, the policy's interest crediting is linked to the performance of a market index, such as the S&P 500. But this is where people often get confused. Your cash value is typically not invested directly in the stock market. You don't own the stocks inside the index. Instead, the insurance company uses a formula to determine how much interest gets credited to your policy based on how the index performs. That's why an IUL is often described as an offering index-linked interest crediting without direct market exposure. But that phrase needs to be understood carefully, because you may have some protection from direct market losses, but you also give up some upside, the upside and downside trade-off. Many IUL policies include what's called a floor. For example, the floor may be 0%. In simple terms, if the index has a negative year, the credited interest may not go below that floor. So if the market drops significantly, your policy may receive 0% credited interest instead of experiencing a direct market loss. For someone approaching retirement, that can sound attractive, especially if they're concerned about protecting assets from market volatility. But there's another side to the contract. Most IUL policies also limit how much upside you can receive. That can happen through caps, participation rates, spreads, or other crediting rules. So, if the index has a very strong year, you may only receive a portion of that gain. This is the trade-off. You may receive some protection from direct market losses, but you don't receive unlimited market upside. That doesn't automatically make the product good or bad. It just means you need to understand what job the policy is supposed to do. If someone presents an IUL as though it gives you all the upside with none of the downside, ask more questions, because the details of the contract determine how it actually works. The tax advantage accumulation story. Another reason people look at IULs is tax advantaged accumulation. The cash value inside the policy may grow on a tax-deferred basis, and if the policy is structured and managed properly, the owner may be able to access cash value through policy loans or withdrawals. This is one of the most heavily marketed parts of IULs, but it's also where expectations can get out of line. The strategy depends on the policy being designed properly, funded properly, and managed properly over time. Policy loans can affect the death benefit. Policy costs can affect performance. Poor funding can create problems later. And if a policy lapses with loans outstanding, there may be tax consequences. So, while the tax features can be appealing, they need to be reviewed in the context of the full policy, not just the sales illustration, because illustrations are projections, not guarantees. They rely on assumptions about future crediting rates, policy expenses, loan activity, and funding levels. And if those assumptions don't play out, the actual results can look very different from what someone expected. That's why I always encourage people to look beyond the headline numbers. Ask what happens under lower crediting scenarios. Ask how the policy performs if costs rise. Ask what happens if you take loans earlier than expected. Ask how long the policy is projected to stay in force. The more clearly you understand the assumptions, the better. And if you have an IUL proposal or an existing policy and you're not sure how to evaluate it, there's a link in the description where you can schedule a free call. We can help you review the policy, the assumptions, and whether it fits your retirement goals. Now, let's address a common question. Should an IUL replace your retirement accounts? For most people, that's the wrong way to look at it. An IUL is generally not a replacement for a 401k, IRA, brokerage account, or retirement income plan. It's a life insurance policy with cash value features. So the better question is, does this policy help address a specific need in your retirement plan? For some people, that may need to be permanent life insurance protection. For others, it may be legacy planning, or tax diversification, or having another source of future cash value, or creating a strategy that isn't directly exposed to direct market losses. But if someone is trying to use an IUL as a cure-all retirement solution, be careful. Retirement planning usually requires multiple tools working together. Some assets may be used for income, some for growth, some for liquidity, some for tax planning, and some for legacy goals. An IUL may fit one part of that picture, but it usually shouldn't be the entire picture. That's why the planning conversation should come before the product conversation. Start with the goal and then decide which tool helps fit that goal. Who may want to consider an IUL? An IUL may be worth exploring for someone who needs permanent life insurance protection and also wants the opportunity for cash value growth. It may appeal to someone who has already funded other retirement savings options and wants to explore tax diversification strategies. And it may also interest someone who wants some level of protection from direct market losses and has enough cash flow to fund the policy properly over time. But there are also situations where an IUL may not be a good fit. If someone mainly wants the lowest cost life insurance, term insurance may be more appropriate. If they need short-term liquidity, an IUL may create too much restriction. If they can't fund the policy consistently, the policy may not perform as expected. And if they don't actually need permanent life insurance, the costs may be difficult to justify. This is where people can make mistakes. They get attracted to the cash value story without asking whether they need the insurance. But the insurance component is part of the product, and the costs of that insurance are part of the contract. So you don't want to evaluate an IUL as if it were simply another investment account. You want to evaluate it as a life insurance policy with cash value features. That lens can create more realistic expectations. Now, let's look at the policy design problem. One of the biggest issues with IULs is that two policies can look similar on the surface, but work very differently in practice. The death benefit structure can vary. The funding level can vary. Crediting methods can vary. The caps, participation rates, spreads, charges, and loan options can all vary. Even the way the policy is illustrated can change how attractive it looks on paper. That's why the design of the policy deserves close attention. A policy designed mainly for death benefit protection may look different from one designed for cash value accumulation. One that's minimally funded may behave differently from a policy that's funded more aggressively. And a policy with loans planned in the future should be stress tested carefully. This is why a second opinion can be valuable. Sometimes the issue isn't that the product itself is wrong. The issue is that the design doesn't match the goal, or the assumptions are too optimistic, or the policy is being used for a purpose it was never meant to serve. That brings us to the biggest mistake to avoid. The biggest mistake I see is product first planning. Someone hears about the tax advantages, protection from direct market losses, or the ability to access cash value, and they start asking, should I buy an IUL? But that's not where the conversation should begin. The better questions are, do I need permanent life insurance? What am I trying to accomplish? Is this for supplemental income, legacy, tax diversification, protection, or something else? Do I have enough cash flow to fund it properly? What happens if the policy underperforms? And how does this fit with the rest of my retirement plan? An IUL is not a magic solution. It's not right for everyone, and it shouldn't be purchased simply because an illustration looks good. For the right person, in the right situation, with the right design, it may play a role in a broader retirement plan. But for the wrong person, it may create unnecessary costs, complexity, and disappointment. Does it fit your goals, your insurance needs, your cash flow, and your retirement strategy? That's the conversation worth having. So, if you're approaching retirement and you'd like help evaluating an IUL policy, a proposal you received, or your overall retirement plan, click the link in the description and schedule a free call now. Together, we'll review your goals, your current strategy, the role this type of policy may or may not play, and help you understand what options may be available. That way, you're not making a decision based on a sales pitch or a one-size-fits-all opinion. You're making it based on your plan, your goals, and what the policy is actually designed to do. Thanks for watching, and I'll see you in the next video.